Good morning, everybody. Actually, the CA Yogesh Thar doesn't need introduction in our study circle because he's a regular speaker. Now, post-COVID, I think he's not come. This is the first time, but earlier, every year, at least one program he used to give us. We all know him that he's a partner in Bansi Mehta and Company, and he's a chartered accountant since 1984. He had stint with SV Gatalia and as a partner in S.A. Kakadian Company before he joined Bansi Mehta. So authored several books, and he was a PhD faculty in Nasimon Institute of Management Staff Studies during 92 to 97. And he's a member of various committees, and especially he was a member of the committee constituted by Honorable High Court in 2014 in relation to major commodity market scam in the country. He has got experience as an independent director also, and he's currently member of taxation committee in Chamber of Tax Consultants. And yeah, with this, I present before you Yogesh that he'll be taking up issues on tax audits, which is as Woody has pointed out, is the need of the day. This is a month we have to finalize all the tax audit. And now we have gone from the era of really postponement or extension. So be ready. So we are on the 3rd September. Just refresh your tax audit, then be on the job. All the best. Yeah, before he takes up the mic, we want to present him a memento. I request Jayesh Shah and Anil Sharma to present the memento. Over to you, sir.
Second last. So I think we'll have to take page down.
Hi, good morning, everyone. Just remembering being with Jayesh Bhai and Vatsa. Remembering the days 1985, 86, just passed out, had a couple of years of experience, and branched out on my own as a sole proprietor practitioner in those days. And there came this bonanza of tax audit in 85, 86. And we were also happy that there is some new line of activity. In fact, before that, during my articleship days, at some point of time, I took a decision that I don't want to do audits. And that is because, I was sent on an audit to one very large cooperative housing society, very, very large society, industrial society in Thane. And then I was doing vouching. In those days, we had those lilac color pencils, and we used to do that vouching of. I came across one voucher, digging of well. I said, very interesting. I told that accountant, I saw all the bills, invoices, payments, etc.
I said कि lunch time में घूमने जाएंगे तो दिखाना यार well कैसा होता है. I've never seen. Living in Mumbai, born and brought up in Mumbai, we haven't seen a well yet. So that fellow started smiling at me and he was virtually like blushing. I said, हंसता क्यों है भाई? So he said, थोड़े दिन के vouchers और घुमाओ, 1-2 महीने के बाद you will get one more voucher, expenses for filling up the well. So well था ही नहीं, and there were double expenses which are booked over there. So from that day onwards, I decided, I told my boss, sir, I'm not going to do audits. Give me anything in tax, no problem. I decided not to do audits. People take us for a ride. But then when this tax audit came, we were all very, very excited and said that something new is going to come. So I was just remembering sitting with Jayesh Bhai, 1985, 86 when it came. I was introduced to somebody known to my father. I went to him, a very, 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 very large trader in metal market in those days. So uh, I just had a quick look at his, turnover and things like that. It was very huge, a partnership firm, not a company. So we had a very nice talk. And then in the end, peaceful is over. So I had in mind the institute's table minimum fees to be charged in those days. And in those days, that fell in the highest category, which was some 6,000 rupees. I'm talking of 85, 86. So the moment I said that, he jumped from his chair. 6,000 rupees was too much for him. And he said, કે આમ તો મારો ભાણિયો પણ CA છે. My sister's son is also a chartered accountant. And he will do it for 500. So I had a blank face. I may not even have to give him 500 rupees. He will just do it. So fine. I mean, so we had a cup of tea and I went away. I never seen his face till today. So these were the days when tax audit was introduced. These were the days, these were the types of clients that we encountered. And we still keep on encountering. But then the responsibilities have kept on adding. The list of responsibilities have been added over the number of years. Tax audits everywhere. Auditors, as we all know today, are a soft target for the government. A lot of work we need to do, a lot of due diligence we need to exercise while we do our work. And so therefore, nonetheless, this is an interesting area of work where if we do not have answers, at least we have a note to be placed in 3CA or 3CD. And then we safeguard ourselves with all those notes of disclosure and carry out this work. So very interesting field. It has kept on increasing. The responsibilities have kept on increasing. The list has kept on increasing over the years. So what I have done, friends, is to try and select certain items where we tend to be little negligent, we tend to make mistakes, or we don't pay much attention to, or things which are debatable, things which have different views. I try to pick up those areas, those issues from the experience of tax audit that we have over the number of years, and certain new issues, how to deal with them. I picked up only those. I'm not dealing with tax audit as a subject as a whole. So therefore, important issues in tax audit is what we are going to do. Because all of us have been doing tax audit for a number of years. So in that sense, it's a very, very old topic. The first one that I've selected is just a sort of a warm-up, where clause 10 requires you to disclose the nature of business. And many a times we copy paste from the last year. And I've had instances where earlier 2-3 years, some new business was started, nobody bothered to write that, the new business, and which continued some old business. I had recently had an instance where some business was sold 3 years back. That still continues, even after the sale. So these are the type of things that happen in these clauses, initial clauses, you don't pay much attention. But at times now, these mistakes may be innocuous, but at times these are fatal, or at times taking more care, in filling up these details can help your case in tax assessments, when it goes into the assessment stage. So one has to keep in mind those issues also when you really, fill up this column of, nature of business. So I listed a few examples here. So say, for example, you want your interest income to be assessed as business income. You want your loan, which has become bad debts, you want to claim those loan as bad debts. So those sort of things happen. But I do not write financing activity as one of my business, and I have never written in the past. What happens? So if your income has been assessed as other sources, and if your income as interest has, then the claiming that bad debts becomes almost impossible. So depending upon this, you have to visualize, you have to focus nature of business, etc. And then you might add, I am a builder and a developer and also a financer. Okay, so then maybe at some time in future this may come to your help. Then rental income, whether business income or income from other sources, or sorry, income from house property. If you want your rental income to be assessed as business income, then it is important that you mention that I am a landlord. My business is that of a landlord, apart from many other businesses, whatever. So that may be one of the issues that can help you. You have decisions, which create controversy on this issue, fine. But if one wants to take a position that my rental income is business income, it is composite letting, etc., etc., then maybe you have various other businesses and you tend to forget because rent is one small item appearing in the P&L account and therefore you forget. So keep in mind those things. Sometimes it may be helpful not to be very specific, and sometimes it may be helpful in becoming specific. Like say, for example, uh, you are at a stage where you are starting a new business and you are setting up a manufacturing plant, and you say that I am in the business of manufacturing of textiles. Then even if you have done trading, you would like to say that I've started trading, so my business is set up and therefore I want to claim the expenses, right? So it would be better if you keep it very general, don't become specific, that manufacturing of textiles. You say that buying, selling, manufacturing, or otherwise trading in, or otherwise dealing in. Say something like that in the business, so that it keeps open, your arguments as regards, that is also part of my business. That is also, my business is set up and things. At times, it is important that you mention that I'm in manufacturing. So say, for example, you are in a situation where you are in a 115 BAB company. If you're 115 BAB company, then it is only the profits which are derived from manufacturing or production of articles or things which will qualify. Otherwise, those profits will not qualify. So it may be important for you to be specific in those cases that, my business is of manufacture or production of articles or things, whatever the articles or things are. If you are a ATIA, if you are claiming ATIA sort of deductions where you have captive power plants or your captive railways or your captive units, then say so that business of generating power, business of operation and maintenance of railway systems, and things like that. So that can support you, to say that I'm in a business and that captive will be eligible for this claim. Uh, Similarly, SSC is claiming deduction under section 36(1)(8). So 36(1)(8) has a lot of eligible businesses, and if you mention that this is also one of the eligible business, because then things become easier for you as you go along. It may be one of the several arguments that you would put that, look, my tax audit also says this. Apart from all other factual aspects, this is an aspect. And moment you say it in the tax audit report, this is the nature of business, the assessing officer in the assessment order, he will cut, copy, paste from there, and he will write in the assessment order also. Nature of business, there's a column over there in 143.3 order. So these two things will help you in your appeals. That अरे यो भी लिखता है ये मेरा business है. I have also written this is my business. So 2 bullet points you get when you are arguing your appeal. Okay. So for the commissioner appeals to take a view, no, it's not your business. So these are the type of things that you need to keep in mind. Achha, in transfer pricing cases, where you are benchmarking yourself, your profits under a TNNM, and you have several comparables. So you would like to select, say, for example, you are in the software ITES enabled services, and you want to select a low-end type of service. If you just write ITES, it may not be very helpful. If you write, I am in a BPO, I am in a, it's, some low-end segment, then that will be again one of the bullet points that will help you in arguing your matters when it goes forward. That look, I have said right from the beginning, my tax auditor has said so. I have said it in my return of income. The assessing officer says it in his order. Then how do you compare me with a KPO? How do you compare me with a software developer? And so on and so forth. So these are the type of things that one has to be conscious when one fills this column, rather than just being mechanical and putting something वो पिछले साल था तो cut paste करके लगा दिया. I think that's just an eye opener, and these sort of things once or twice in a year we come across, in every audit. So especially new audits, when you look at things afresh, then these sort of things come up. So I thought I'll just flag it over here so that we are all conscious of dealing with this issue. Then one or two small issues on ICDS clause 13. ICDS is income computation standards. These are not accounting standards, right? So therefore, I need to obtain the draft computation statement from the SSC when I do my tax audit. Do I do that? I don't do it, because after the tax audit is completed, the draft computation starts. I have to obtain and I need to write that. Just look at this paragraph of guidance note, paragraph 25.11. For the purpose of replying to clause D, the tax auditor should obtain draft computation of total income and disclosures required under ICDS. Based on the information and books of account, the tax auditor should consider whether any adjustment is required to be made on the profit and loss account, and if the answer is in the affirmative, to state yes, otherwise to state no. While reporting, auditor is to consider draft of income computation provided by the SSC. This fact should be mentioned in audit report in paragraph 3 in form 3CA and paragraph 5 3CB. Do we mention? Many a times we don't. So we need to keep this in mind, that the preparation of computation is the responsibility of the SSC. We need to be clear on this and state so in the tax audit, paragraph 3, and our guidance note actually helps us to say that, and which will also show, which will demonstrate that you are not a tax computation preparer. It's the SSC who is preparing his computation statement. You have given me the draft. Look, I made a mention of it in my tax audit report. Then 13E says the answer is positive, then I have to give increase and decrease in profits, etc. That is fine. Now, ICDS 1 talks about disclosure of accounting policies. So many a times what we do is the accounting policies that are mentioned in the accounts, we just make a reference to that, or at times we copy paste from there, which may or may not be right. These, as I said, are computation and disclosure standards. These are not accounting standards. And therefore, when these standards talk about accounting policies, it actually means computation policies. In fact, para 3.6 and 5.3 of the guidance note says so, that the term accounting policies in ICDS 1 should be read as computation policies. This would make the provision of ICDS 1 relating to substance over form and non-recognition of mark-to-market losses applicable only for computation of income and not for the accounting purposes. So what is my computation policy? My computation policy is that I start with my profit and loss account, whether it is IGAP, whether it is Ind AS. I make adjustments as required under ICDS. And then I make adjustments as required under the Income Tax Act and rules independent of ICDS. And that is how I come to my total income. So this in one sentence is my computation policy. Okay. Then you go ICDS wise and give your policies. Okay, what is the policy for valuation of stock? What is the policy for forex difference, etc., etc. So, and in every case, it is possible that your accounting policies may not match with what is required under ICDS, and therefore the disclosure of the policies should be in line with ICDS and not just necessarily copy paste from the accounts. So, for example, mark-to-market losses could be different. It could be different under IGAP as well as under Ind AS. It would be different under Ind AS. Your accounting policies, your ICDS one says mark-to-market will not be allowed in any cases other than cases where they are specifically permitted under the other ICDS. So that could be different. There may be different policies for say retention monies, and because retention money may have to be treated as treated as a provision under your accounting standards. It may have to be treated as income for the purpose of ICDS. And leave aside everything else. Your accrual itself may be different. The accrual concept itself may be different because accrual concept as understood under the IT law is different from the accrual concept as may be understood in accounts, because you have the concept of right to receive under the income tax law. That is what the Supreme Court has said in ED Sassoon and then Excel Industries and all. So there should be an income which is earned by a person. And the second condition for accrual is there should be a liability on the part of the other person to pay. So if there is no liability, there's no right to receive. And therefore, even if you have earned something, but you don't have a right to receive it because there's no corresponding liability, it may not have accrued. So, and the typical example could be that interest accruing on on the coupon date. So interest accrues on coupon date, January and December, January and June are say the coupon dates. What do you do in the month of March? Do you accrue or do you not accrue? Things like that. So therefore, the accounting policies are not necessarily to be cut paste from the accounting policies into the ICDS disclosure. One may have to apply your mind and look at it from the ICDS point of view. Now, one common debate and a practice which differs from firm to firm is as regards Ind AS adjustments. Should Ind AS adjustments necessarily be part of your ICDS adjustments, or it should not be? There are two schools of thoughts, varying practices. One would say no, because, as I said, accrual is understood in tax as right to receive. These twin conditions should be satisfied as per the decisions of the Supreme Court, that I should have earned and there should be a liability on the part of the payer. These principles, I may argue that they are well settled principles in law. And therefore, it is the concept of accrual that you find in Section 5 of the Income Tax Act itself. I don't have to go to ICDS and interpret accrual. Even if I go to ICDS, interpret accrual, that accrual will be in the line of what Supreme Court has said and nothing beyond that. So therefore, the adjustments are not adjustments under ICDS. There are anyway adjustments under Section 5 of the Income Tax Act. And therefore, I will say that, all right, whatever is fair valuation done through P&L account, there is no accrual at all. And therefore, I need not, and therefore, I will have to reduce it in my computation of income. I reduce it, no doubt. But is it an adjustment of ICDS or is it not an adjustment of ICDS is a conundrum which is there and which shall remain, and different views can be taken on this issue. But whatever you do, I would feel that one should be consistent in the approach and make a disclosure that the adjustments which are under section 5 of the Act are done in the computation statement, draft computation that is given to us, and therefore they are not disclosed as part of ICDS adjustments. There could be effective interest rate adjustments. So many, because of the fair valuation concept, because of the discounting theory that you apply in Ind AS, there may not be accrual of interest, or there may not be a charge of interest, but you would find those credits or debits in the interest account in the Ind AS accounts, and those adjustments will be required. So the questions will still arise whether these adjustments are part of ICDS in borrowing costs, or whether these adjustments are otherwise part of Act itself, because there is no liability to pay, and therefore 37, that interest has never I've not incurred that expense. Okay, so whatever system one follows, one will have to be clear in the notes that I write that these adjustments have been made in the draft computation under the provisions of section 5 or 37 or 28 of the Act, and therefore they are not separately disclosed as ICDS adjustments. And if you choose to do it, then you do it, and then say that therefore these adjustments are by themselves complete, and therefore no further adjustments are required. Then I also wanted to touch upon, when we deal with mark-to-market losses, mark-to-market gains also has an issue. See, mark-to-market losses, basically, it's a concept of prudence. You had that concept of prudence in AS1, which was issued under Section 145 by the CBDT earlier. Now that concept has gone. You don't find the concept of prudence in ICDS. And therefore, they say mark-to-market losses are ultimately based on concept of prudence. But now ICDS doesn't seem to be prudent. So it doesn't have that adjustment. But anyway, those specific ICDS which have, like say, for example, stock has to be valued at cost to market price, whichever is lower. That's based on principle of prudence. Foreign exchange mark-to-market losses are allowed in certain circumstances on provision basis. On certain circumstances, they are allowed only on settlement basis. So those which are allowed mark-to-market will be allowed. Those which are not allowed and allowed only on settlement basis will not be allowed. So yeah, but there could also be situations of gains. So mark-to-market gains also would be there. And since ICDS 1 does not permit mark-to-market gains, your Ind AS may permit mark-to-market gains. And like fair value through P&L is one of the examples of mark-to-market gains. So so therefore, if you are showing it under ICDS, it may help you in both the ways. Gains, losses as well as gains, both will not be liable for include gains won't be included in your computation, and losses will not be permitted in computation. But at the same time, one can take a view that for gains, as I said, there is no accrual. Okay, accrual is right to receive, there's no right to receive, then I'll make an adjustment in section 5 as the need of doing it in ICDS. So there is no final answer to this. Whatever one follows, one may follow it consistently, and therefore make a complete note of disclosure. What is the safe way of doing it? Show it. You see, once you include it in your 3CD, then just make sure that it definitely enters your computation, because otherwise it will be picked up under 143(1), and then you will have no answer to it later on. So safe way would be not to include it in 3CD, and you take your calls independent of 3CDs to the extent you have a proper answer, either based on accrual or liability to pay. That's it. Then there are issues which arise on recognition of subsidies. And this is one of the examples also where ICDS may give a different a different requirement as compared to India's. Your Section 224 now includes all subsidies as income, other than those which are to be excluded from the fixed assets. They are directly connected with fixed assets, have to be reduced over there. The paras 4 of ICDS 7 says government grants should not be recognized until there is a reasonable assurance that the person shall comply with the conditions attached to them and the grant shall be received. Recognition shall not be postponed beyond the date of actual receipt. So, reasonable assurance is what has been said by the by your ICDS. Para 14 says the disclosure of nature and extent of grants recognized and not recognized, and if not recognized, the reasons thereof. So, if I have not recognized a particular grant or a subsidy, I have to disclose why I have not recognized. So, question arises that when your ICDS provides that something has to be recognized only when there's a reasonable assurance, and therefore I don't recognize. And if I don't recognize, then there is a question of disclosure if it is not recognizable. So the question is, if I can frame it, that the disclosure of subsidy which is not recognized, is it required if according to me it is not recognizable? So I come to a conclusion that there is no reasonable assurance of its ultimate receipt, and therefore I don't recognize. And if I'm complying with that, should I still disclose that I have not recognized that? The view that we have taken is that I have to disclose something which is not recognized only if it is otherwise recognizable. If it is not recognizable, then there is no question of disclosing it, because then there is no end to it. What is the cutoff date that I take? A cutoff date when I made an application, a cutoff date when I got the eligibility letter, a cutoff date when something is some queries are raised on me, and I have to answer them, or what. So that becomes an issue. So if it is recognizable, the view I take that it is recognizable because I feel there is a reasonable assurance, and it is not recognized, then you disclose. Otherwise, there is no question of disclosure. But then at the same time, one needs to keep adequate working papers to show that it is not recognizable. Questions will arise that, all right, what sort of papers do I keep? I mean, one will have to look at the past records. One will have to make an objective assessment as to whether this is recognizable or not recognizable. And it is very common that in receipt of these subsidies or grants, there are a lot of delays. But then at the end of the day, you definitely receive it. So is it a mere delay? Does mere delay give rise to your taking a view that there is no reasonable assurance? I would feel no. That based on the past record, there have been delays, no doubt. But then I have certainly received it. There are no different facts that have happened this time. So, and therefore, merely because there is a delay, do I have to, postpone my recognition? Answer is probably no. I cannot postpone the recognition because there is a reasonable assurance that I will comply with the conditions, and there is a reasonable assurance that I have received based on my past records. At the same time, you'll also have to keep in mind the requirements of various paragraphs in ICDS as to when you should recognize what subsidies. And by and large, they go on a matching concept that if there is an item of expenditure, like say transport subsidy, then you account for it when it is receivable, or you match it with the match it during the period when the costs are incurred. So by and large, it goes on the matching principle. But then if it is not receivable, it becomes receivable when you receive that letter of eligibility. In which case you have to. But if if you are eligible, but you have not incurred, obviously there is no question of, accounting it for it or recognizing it. So one will have to keep in mind the requirements of paragraph 6, 8, 9, etc. As to the broad theory of recognition is matching costs. If you have to meet certain conditions, and therefore for meeting those conditions you will have to incur costs. In which year you will meet those conditions, in which year you will incur those costs. Depending upon that, you will have to account for it. So meeting conditions, so a subsidy which is to be received based on conditions to be fulfilled is a contingent asset. It is not an asset. Having fulfilled those conditions, it will be received, and therefore there is a reasonable assurance that you will receive, and you account for it. But then the question will be, when do I account for it? I account for it when in the year in which I have incurred significant expenses for meeting those conditions. If that's the year in which you will account for it. So friends, these are the aspects that one needs to take care in subsidies. There is no one single answer for all different, depending upon your different situations, there will be different answers. One will have to sit down and apply it. Then 145A, method of valuation of closing stock. 145A, as amended few years back, also has not just goods, purchase of goods and service, purchase and valuation of purchase and sale of goods. It also talks about goods or services, and therefore question arises that will the valuation of services be required to be reported, and if so, how do I do it? So clause 14A says method of valuation of stock employed in the previous year. So it talks only about stock. But B says in case of deviation from the method of valuation prescribed under 145A and the effect thereof on the profit and loss, please furnish your increase, decrease in profits. So does B refers to 145A as a whole, or should B be read with A, and therefore A, which talks of closing stock, I restrict myself to that. I restrict myself to inventories. The word closing stock will have to be interpreted as inventories. It will be closing stock, opening stock, whatever it is. So therefore, you would be paying your GSTs on services. You will be paying your GSTs on expenses which are debited to your profit and loss account. Do I need to disclose everything, or do I have to restrict myself to inventories and that's it? If one look holistically, then all the entire GST paid on all your expenses will go to go for your calculations of ITC credits, and therefore everything will have to be ultimately reported. Many large companies are not reporting anything on 145A for many years now. Because they are referring to the guidance note and saying that, look, guidance note is very clearly saying that there is no effect on the profit and loss, and because of the number of units and large number of data, it is not possible for us to compile it. And nothing has happened to them. In the assessments, regularly, whatever GST embedded in the closing stock, they call for the data that is given, they make additions, and the appeal authorities remove it. So this is the way in which things have happened. And non-disclosure in 145A, in clause 14, in quite a few cases, we have seen nothing significant has happened. But of course, robust notes will have to be written, and that will be justified only if you are a large company with several units and several products. Of course, the guidance note does not throw any light on whether to include services or not to include services. But as I said, if one were to look at clause A and clause B together and not in isolation, then the requirement of reporting will be only in respect of the inventories or stock and not in respect of the services. This is one of the typical note that one writes in 145A. Says 145A requires to adjust the valuation of purchase and sale of services to include the amount of any tax, duty, cess or fee actually paid or incurred by the SSE. That is, adjustments are also to be made for input tax credit availed and utilized or taken for GST in respect of purchase and sale of services. ITC for all types of items or services purchased are reflected in the books of account on an aggregate basis in ledger accounts maintained therefore and are not based on the nature and or type of expenses or services. Further cost of services could have been included either in the cost of goods produced or as administrative or any other expense. Considering such significant complexities involved to determine the amount of ITC for purchase of services, it is not possible to work out separate impact thereof. It may be noted that as explained earlier, because an earlier note would say that your guidance note says that there is no impact, whichever way you look at it. And therefore, I reiterate over here and say that as explained earlier, the net impact on the profit and loss is always there. So this is how a typical note goes when I don't want to include, the GST element on services, etc. But then because 145A has this element, you can't ignore it and just say nothing about it. Then there is interesting para in the exposure draft of the guidance note that I think should get finalized very soon. I think August was the last date of giving the responses. As of today, it is still exposure draft is not yet finalized, but it should be finalized anytime now. So that exposure draft requires disclosure of subsidy specific to fixed assets. Okay, it says and it says that something which is specific to fixed assets, you're supposed to reduce from the cost of the fixed assets, and that they are saying you should include it by way of reporting it as amounts not credited to the profit and loss account. There is A, B, C, D, E in clause 16, and that last clause E talks about capital receipts not credited to the profit and loss account. So the guidance note says that these sort of subsidies should be reported over there. Now, technically, one has no problem in reporting it over there. But moment you report over there, the fear always is that 143(1) may be picked up because you have not made a corresponding adjustments in your computation. Obviously, you will not make because it's a capital receipt. And I have actually reduced from my depreciation. So if I report there, the possibility of that addition being made in 143(1) and then you're getting into that litigation are there. So I'm not too sure whether we will do this, but at least definitely because the guidance note says so, one will have to write a note saying that because it is reduced from there, it is not disclosed. That sort of a note, if it is written, then it covers up, you're not having mentioned, despite the guidance note requiring it to mention. So one may give a note that subsidies that are reduced from the cost of fixed assets are not included in reporting under clause 16, and these are duly disclosed in clause 18 because I'll be reducing it from the block of assets unless it is land. And they're duly disclosed in clause 18 against the relevant block of assets. So you may say that and get away with it. So that's the fear that if I really comply with this, then there's a fear that unnecessary additions will be. On 17 and 18, immovable property and depreciation. This is more of a legal issue, and at times you do find that there is an adjustment which is required on account of stamp duty valuation being more than the value at which you dispose of the property, and then now you are mandated that the tax auditor will have to report. The question arises that, all right, if it's a depreciable asset, what do I do? It does not make a difference so far as depreciable asset is concerned, because I'll say I'll reduce it from my WDV. I still have a very large block. It does not make a difference to me. I'm not getting taxed under section 50. So effectively, I'm not paying any tax today. So question arises as to when when there is no, so if there is section 50 profit or if there is no section 50 profit, what one has to do? Yes, of course, if there is a section 50 profit, it will have to be computed based on stamp duty value and not based on your actual consideration, because you have the decision of the special bench in United Marine which says that in computing your profits, deemed short-term capital gain under section 50, 50C will apply. So you do that. However, if there is, so if you do that, then the block comes to an end and therefore there is no further depreciation being claimed. But if there is no 50 profit, having tested against your opening WDV, you reduce the stamp duty value of the property that you have sold, and it still does not give rise to any capital gains under 50. Then the question comes, all right, there is no capital gain under 50. Now what do I do? When I have to disclose for my clause 18 the WDV, okay, what do I reduce from the WDV? Do I reduce monies payable or do I reduce the stamp duty value? 43.6 does not talk about stamp duty value. 43.6 talks about monies payable in respect of assets sold, discarded, demolished, or destroyed. So when you come to 43.6, you have to reduce the monies payable in respect, and therefore the consideration that is payable is to be reduced and not the stamp duty value. So reconciling these two things, if there is a profit under section 50, obviously it will have to be computed based on the stamp duty value. So you apply stamp duty value and decide 50 ka profit hai ki. If it is there, offer it that way. If it is not there, then for the purpose of your WDV, you don't have to reduce the stamp duty value, you have to reduce the monies payable, and that is the amount as per the consideration received or receivable under your agreement. Now, this impact of the Supreme Court decision in checkmate. Clause 20 small b, don't go by the capital B because the titles were not allowing me to type a small alphabet. So 20 small b, details of contributions received from employees for various funds as referred to in 3615A. And then I have to give these details: serial number, nature of funds, sums received from the employees, due date of the payment, actual amount paid, and actual date of payment to concerned authorities. And if there's a delay, now there will be a complete disallowance and a permanent disallowance because of the decision of Supreme Court in checkmate. So what is the scheme of the Act? 224(10) is there in the statute, which says that any sum that you receive from the employee, you receive or you deduct from his salary as good as received, that becomes the income. Okay, so I have paid a salary of 100 but deducted PF of 10. So that 10 which I have deducted is first to be treated as my income. So 100 is my salary debit, but 10 is my deemed income under 224(10). Then the law says 3615, if you have paid it before the due date, you will be given a deduction. So that 10 which was a deemed income, if I have paid before the due date, it becomes my expense. What is the due date for the purpose of 3615A? It is a due date which is mentioned in the relevant regulations, law, statute, act, agreement, or whatever it is. So that is the due date. It is not the due date of filing the return. Now, and earlier you had Supreme Court, earlier that Vinay Cements and other decisions had taken a lenient view that that is also something which is covered under 43B, and therefore so long as you have paid before the due date of filing the return, you will be allowed to claim it as a reduction. But now checkmate Supreme Court has ended that game. It's not checkmate, but they've ended the game at all, and they've said that no, you will not be allowed at all. It's gone for once and for all. You'll never be allowed that deduction. Fine, fair enough. Now, today, after this decision, questions arise. Yeah. Huh. So what would happen over Ace Builders is that you will claim it. So there is a capital gain under section 50, no dispute about that, right? That capital gain, the question is whether you are entitled to 54 deductions or whatever deductions you are claiming. So you claim those deductions. See, when it comes to clause 18 depreciation, that block is gone. So there, okay. So that's a good question from the point of view of utility. That thus the practical difficulty that we are faced is that if you want to take advantage of ACE builders, the utility does not permit it to do so. And therefore, in fact, in 2018, we filed a writ petition in the Bombay High Court in a matter. We were in the month of October and we realized that the utility does not permit me to claim this deduction. So, so we filed a writ petition in the High Court, and the High Court actually directed that, look, there are case laws on the subject. Your utility cannot govern the law. And therefore, if the SSE wants to make a claim, let him make a claim. You accept a physical return. So the writ court directed the tax department to accept a physical return. No, I understand. So this can be afforded because there my stakes were in crores, and therefore somebody was willing to file a writ and we got a good order. In fact, thereafter, in that very decision, the Bombay High Court directed the CBDT to lay down guidelines that this is not only one instance, there could be several instances where I want to take advantage of the provisions of various decisions, but your utility does not permit me. Please lay down guidelines in such cases. What should the SSE do? CBDT has not done anything so far. It is 2018 reported decision of Bombay High Court. Now, that is what it is. Now you say that, okay, my utility does not permit. In a small case, I don't want to go and file a writ petition. What do I do? The answer to that probably would be that you file your return and make a claim by way of a letter to the assessing officer that your utility is not allowing me to do this. And therefore, my claim is, I'm making this claim through a separate letter. You do that. If your case is selected for scrutiny, that separate letter will help you. If it is not selected for scrutiny, it may never happen. Okay. So in such cases, you'll have to find some innovative way of doing it. Make a claim in some other column in the return. Don't go by the same column. You make a claim in some other column in the return and file it in a letter that I'm making a claim not in the relevant column. I'm making a claim in some other column because your utility is not allowing me. And this claim is based on these case laws. And therefore you consider it while filing. 264, see, once again, you are at the mercy of the commissioner. 264 is not an appealable order, right? So you are at the mercy of department. My approach will always be to come out of the department, go to the appellate authority. Somewhere down the line, you will get relief. Okay, so it is an option. I'm not saying it's not an option. It is an option. But again, against 264 not appealable, you will have to file a writ. So these small SSCs will not afford all those things. So you'll have to be innovative in this. Wherever in a utility you are not able to make a claim, most of the time we make a claim in a column which is irrelevant, others or somewhere. No. In the depreciation schedule, so it block will become nil. Your clause 18 will be no depreciation. So that has gone. So for here it will be a short-term capital gain under section 50. It will be fine. Now tax audit chapter is over. Now the question is that where will it go in the return? So that is where we are saying in the return, practically, if you want it to be treated as long-term, it will not allow you to do it. And therefore you will have to make a claim in some other column. No. All right. So law, if you have read, sorry, if you have read the title of Mr. Palkhiwala's book, the title of Mr. Palkhiwala's book is Law and Practice of Income Tax. So it's not just the law. You'll have to be innovative in your practices also, and make sure that those practices, implement the law correctly. The utilities, the softwares are not made, they are not the law by themselves. They've evolved over a period of time. And therefore, okay. Then where were we? 20B. Huh? So we were on this income deductions from the salaries of the employees, and that becomes my income. It is allowable if I pay before the due date. So now after this decision, the issues arise as regards contribution to national pension funds, contribution to certain staff welfare funds, benevolent funds, superannuation funds. Now, what happens in these cases? 224(4) definitely applies. Now, why these cases I'm pointing out is because these are the cases where there are no due dates mentioned anywhere. You don't find due dates in a benevolent fund. You don't find a due date in NPS. Before what date it has to be filed. So, however, because the wide scope of 224, as I said, 224 applies to provident fund, superannuation, ESI, or any other fund for the welfare of the employee. So it's very, very wide, right? So any other fund would be very, very wide. So it does become my income, deemed income. But 3615A, how do I implement? I cannot implement 3615A because there is no due date mentioned in it. So what happens? Where do I get a deduction? The answer is simple. I get a deduction under section 37. Under section 37, it's an expenditure laid out or expended for the purpose of my business. I've collected from the employee, I have to pay it. I'm holding it in trust for the employee. Law only deems it to be income, but then if I make a provision for payment to that fund, then it should be allowed under section 37. So 3615A, not implementable because there is no due date under that particular law or order or funds rules and regulations. So therefore that section not implementable, and therefore it is allowable under 37. Your provision is already sitting somewhere in the debit of the P&L account, either included as part of salary itself, because this is a deemed income. So when you paid salary, you debited gross amount of salary. So the debit is already there. You have paid cash of 90 out of 110 is somewhere appearing as a liability. May not be the same head, but there is a liability which is shown. So there is a proper provision made in the books of account. And therefore, this is an expenditure which is otherwise allowable under section 37. Now, so therefore, on these cases, as of now, we come to a conclusion that it is deemed income, but it is allowable under 37, 3615A, not applicable. Then, what is the interplay with 43B? Does 43B come in over there? And do I have to report under clause 26 when it comes to 43B? 43B says, clause B says, any sum payable by an SSC as an employer by way of contribution to PF, etc., etc., etc. Is it a sum payable by the employer? Answer is no. It is the employee's contribution which I have deducted. Compare this with the language of 3614. You see, in 36.1 you have 36.14, which is meant for employer's contribution, and 36.15A, which is meant for employee's contribution. Two separate clauses in 36. Okay. The language of 43B is exactly the same as language of 36.14. And it says says any sum paid by an SSC as an employer by way of contribution to PFSA. So therefore, 43B will not apply to employees' contribution. Now, of course, you have explanation 5 in the statute itself after all this maramari, checkmate, etc. That 43B applies only to employers' contribution and not to employees' contribution. And this view is also now supported by the decision Supreme Court in checkmate. And therefore, 43B is not applicable to the employees' contribution in respect of these things that we mentioned: NPS, staff welfare funds, superannuation funds, wherever there is no due date mentioned. And consequently, the amounts provided in the books towards these employees' contribution will be allowable, even if these are not actually paid, not even paid before the due dates. And finally, while we are on this subject, what is the interplay with 40A9? 40A9, once again, clause 21F of the tax audit report. 40A9 applies only to sums paid by the SSC as an employer. So employer's contribution to a fund which is for the purpose of welfare of employees, which is not one of those approved funds, etc., is completely disallowed. It will never be allowed. But then that talks about employer's contribution. It doesn't talk about employees' contribution. And so once again here, 40A9 does not apply, and therefore reporting in 21F also is not required. Whether PF obligation of labor contractor is to be disclosed. This is another issue which comes up every now and then. Now, company has paid the contractor, the labor contractor, a full amount. Company has done TDS under 194C when that payment is made. Okay. That labor contractor has not made his payments. Okay, so the contractors, the payment made to the contractor are the charges which are otherwise allowable under section 37 for the company, because these are his bills towards labor contract and these are allowable in 37. The contractor himself would have deducted PF from the employees, and for him it would be a 224/4 income, a 224/10 income, and it would be allowable to him under 3615. The labor laws casts a responsibility on me. In case the contractor fails, I have to pay, no doubt about it. But that is under the labor law. So far as the income tax law is concerned, it is not my 224 income. It is not my 3615A expenditure. For me, it is a 37 ka expenditure. And therefore, it is for the contractor to report in his clause 20B. If he is liable to tax audit, if he is not liable to tax audit, there is no question. However, it is possible that the company at times makes a provision. Company may make a provision on the side of safety that if that fellow doesn't pay, especially if he's a one-timer, if he is not a known person, not a big person, for some particular project you have used him, etc. Then a company makes a provision that in case that fellow doesn't pay, I'll have to pay. So on conservative policy, prudence policy, company makes a provision. Now, such type of provisions may become a contingent liability provided in the books of account, because that liability will fall upon the company only in a case where the contractor himself does not meet the liability. And therefore, so far as the company is concerned, that provision would have to be reported in 21G, which is a contingent liability provided in the profit and loss account. So on this subject, interplay between various clauses, very interesting, and one will have to keep in mind all these clauses dealing with such legal provisions. Yeah. Yeah. So provident fund. Okay.
Once if the funds are recognized, what will happen if the funds use that to the fund?
Right. So good question. So you made an application for approval or registration. It is not yet registered. So the law on the subject really is, a general law is that any application, any approval relates back to the date of application if it is approved. Okay, so that's a general law. You had Birla Brothers, one very old decision of Supreme Court in this, and then there are quite a few decisions on this proposition that an approval relates back to the date of application. You may, for the delay on the part of the authorities to grant an approval cannot go against you, because you cannot be penalized for the wrong of the department. Okay. So therefore, yes, on a conservative side, you may disallow today in the return, but reserve your right to claim Alternatively, because you may not be selected for scrutiny, and if you disallow in your return, it will always be disallowed. It may be better if you claim in the return and make a note saying that, look, I'm making a claim, I'm disclosing to you that approval is still pending. Okay, and all these things used to happen in your 35 2AB cases. 35 2AB approvals were not coming for years together. But still, I would choose to make a claim so that at least by the time appeal comes up, that claim has come, that approval has come. Then you are entitled to it. So, so you keep this general principle in mind that an approval relates back to the date of application and make a claim. Because if you don't make a claim and a case is not selected for scrutiny, wo gaya na hamesha ke liye. You will never get it. So better make a claim, make a proper note of disclosure and keep it alive. You claim it, that's what I'm saying. Claim it now and write a note of disclosure that, look, I'm making a claim, I've made my application. The application is presently pending. So that you are completely disclosing, there's no concealment, there is no misrepresentation, there is no, under reporting and things like that. Make a disclosure. That disclosure obviously may not be able to make in your return. So what we do is we write letters after filing the return that, these are the like notes to returns. In good old days, we used to have corporate returns used to be 30, 40 pages. The seniors over here will vouch for that. Any corporate computation statement would be 20, 30, 40 pages because 2-page, 3-page computation and 20-page notes to the return of income. So we continue that practice in many cases even today. We file it physically or we file it now, upload it after having filed the return of income. Or at least at the time when 143.2 notice comes for the first time, because they say you give me 143.2, the standard line is whatever you want to file in support of your return, you file. So we upload this at that time before any queries come from their side. We upload those computations. So you claim it with the notes, no problem. Yeah. Then what is this? TDS on provisions. Requirement of the law, section 37. Allowance of expenditure laid out or expended for the purpose of business. ICDS 10 says provision to be recognized when the present obligation as a result of the past event and outflow of resources is reasonably certain and reliable estimate can be made. Chapter 17b generally talks about TDS at the time of credit or payment, whichever is earlier. 21b of Form 3CD, Section 40A1 and 40A 1A, 30% disallowances TDS is not done. So this is the legal requirement. Now questions arise as regards certain provisions. Provision for, say, site restoration. So I'm a telecom company and I have an agreement with a society that you allow my towers to be placed on the top of your roof, and when I will remove it after the end of 5 years, I'll restore your terrace in a proper condition. Or there may be a bigger thing like, say, restoration of mines. So I have a mining license. After 30 years, I have to give back the mine, after restoring it, refilling the land, etc., etc. So these are the expenses which are, which are site restoration, mine restoration. There can be expenses of warranty. I mean, I may make provisions for warranties. I have sold an air conditioner, and there's an inbuilt warranty, and I have taken the full. There is no separate warranty fees taken from the customer. So I have sold the goods and recognized my income. But there is a possibility of warranty getting invoked. So based on an actual valuation, I make a provision and I claim it. So these are the types of provisions where these provisions are allowed under the law. As I said, ICDS 10 would give certain examples also of these. Earlier AS 29 gave examples, and ICDS 10 is following the same language without the examples. That these are the expenses which are arising, which are present obligation arising out of the past event. So my obligation is there. If I have to restore a site after 5 years, I keep on making provision for that over a 5-year period. I do not know at the end of the 5th year to whom will I give contract. but I necessarily will have to incur that expenses because my obligation is there under my agreement, which has already been entered into. And therefore, I keep on making provision for that. So these are the cases, friends, where I do not know who the payee is going to be. The payee is not identified. And when the payee is not identified, how do I do TDS? The requirement of 40A1 is that I will not allow you any expense which is subject to TDS if you have not done TDS. So definitely for restoration of the site, say for example, I will appoint a contractor, and that contractor I will have to do a TDS under 194C at that time. But today when I'm making the provision for restoration of site, which is allowable as an expenditure, but today I am making a provision for warranty. I do not know whom, what sort of expenses will be incurred on warranty, what subcontractor I will appoint to go and repair that AC tomorrow. I don't know that. So, therefore, while those provisions are allowable, okay, but at the time when I credit that account of provision, I don't know who the pay is. It's a provision which is made. And therefore, the question arises whether TDS is to be done, not done. How can I do TDS? I cannot do TDS because pay is not identified. So, therefore, you have decisions on this line that when a pay is not identified, especially I think the earliest one was IDBI Bank stays, where where interest was paid on coupon dates, January and December, January and June, say for example, are the dates on which the debenture coupons are there. And in the month of March, I make a provision for interest for the 3 months period, January, February, March. But those debentures on which the interest is provided are transferable debentures. And in the month of June, those debentures will be with somebody XYZ whom I don't know. They are marketable, they are sellable on the stock exchange. So at that point of time on the coupon date, Mr. X will be the owner. Today, Mr. A is the owner. So how do I do the TDS provision at all? So IDBI Bank, Bombay Tribunal, that was the first decision, and many other decisions are there that when a payee is not identified, TDS provisions are not workable. So all these sort of cases where TDS provisions are not workable, but that provision is otherwise allowable expenditure for you, what do I do when it comes to TDS reporting? So there the disclosure in Form 3CD by way of a note to Form 3C or 3CD gives citations of cases where TDS is not required, where the payees are not identified. That is important to be done. This is not something which is disallowable as such, because these are the provisions which are recognized, which are to be recognized by under ICDS itself, and therefore allowable as an expenditure. Then comes an interesting question on benefits given in kind. Now you have this 194R, a section which haunts everyone every day. So that provision applies to benefits given in cash and kind both. We are not going to get into that maramari right now, but the point is, so far as 194R is concerned, if there's a benefit in kind, and if TDS is not done, do I have to report or do I not have to report? Right now, I'm wearing the hat only of the tax auditor, not of a consultant, not of the SSC. So, question is, do I have to report or I not have to report? Is there a possibility of not reporting? The answer seems to be yes. 194R applies where the benefit in kind. And what does it say? It says that the SSC has to ensure that the tax required to be deducted has been paid in respect of that benefit. You have a similar provision in 194B, where those games and card games, etc. Where the winnings are in kind. What does it say? Again, the similar language. Ensure that the tax has been paid in respect of the winnings. So what are the obligations under these provisions? To ensure that the tax has been paid. There is no obligation to deduct tax at source. Right? Now, compare this with 201. 201 says, where any person who is required to deduct any sum in accordance with the provision of the Act does not deduct or does not pay, there is a These words does not pay has come in little later. They were not there earlier. Or after deduction fails to pay. This is the language of 201. Now, in the okay, before going into the case law, 40A1A, what does 40A1A say? Say 30% of the sum payable on which tax is deductible at source under Chapter 17B, and such tax has not been deducted or after deduction has not been paid. This is language of 40A1A. 201, the words does not pay were introduced in 2002. Prior to that, 201 only had these words, does not deduct or after deduction fails to pay. These were the only two phrases which were there. In the context of that provision, you have the Karnataka High Court in Hindustan Levers case, where it's held that 201 is not applicable for TDS in kind. It went on to say that there could be penalty, there could be prosecution. We are not dealing with that. But you cannot be treated as an SSC in default under 201 because 201 applies where there is an obligation to deduct and you have not deducted, or after deducting you have not paid. There is no obligation cast to ensure that the payment is made. Now, that being the position and the language of the old 201 and the language of 40A1A being the same today. 40A1A also does not say that fails to ensure payment or fails to pay. It only says tax has not been deducted or after deducting has not been paid. And there is no obligation of deducting. How do I deduct? I can't deduct. There is no, I only have to ensure that it is paid. And therefore, there's a very strong view that in case of these benefits in kind, especially after 194R, this is something which is difficult for all of us to actually even implement it, to check it. But nonetheless, there is this particular decision which can come to a rescue. And the Karnataka High Court held that there is no deduction which is possible, only payment has to be ensured, and the same rationale may be applied to 40A1A. Of course, adequate disclosure will have to be made in your Form 3CA, 3CD notes. So this is another topic which comes up in the tax audits for the current years, and I thought it's important that I share this with all of us so that then whether reporting is required in case of short deduction. So this also question comes up many a time that I have deducted, but there's a short deduction. And this also is a fairly well settled position that 201 says where any person who is required to deduct any sum in accordance with the provision of the Act does not deduct or does not pay, or after deduction fails to pay the whole or any part of the tax. 201 talks about the whole or any part of the tax. 40A1A does not use the whole or any part of the tax. It just says such tax. Okay. So therefore, the words whole or any part of tax which is there in 201 is missing in 40A1A, and hence disallowance is not applicable in case of short deduction. It applies only to complete non-deduction, and this view is supported by several decisions which I have given here. And of course, the again note of disclosure in 3CA, 3CD that we are relying on this decision, and short deduction is therefore not reported. Yeah. So the payee has paid his taxes. So under that circumstances, the disallowance also does not apply. There's a specific provision now made. Earlier it was not made, so it's not required. There is no separate column for that, but I think we do write a note on that. If that is done, you do write a note on that. That these cases where the payees have deducted and the necessary forms have been given, they have not been reported. That should be because it is a compliance of the provision. You in the disclosure, in the notes of disclosure, you write. not in the main column itself, but you write notes to 3CD and attach it. There you mentioned that in clause, because we have clause-wise notes to 3CD. In the clause-wise note, you mentioned that these cases are not included.
Specific,
They're not required. Not required. Not required. Not. No, no. No. Bonus comes. Yeah. No, no. It will have to. I don't remember that. I really don't remember whether it goes there. But you get a copy of that. I don't remember whether it's. There's no requirement. Huh. I don't remember, but Jayesh Bhai says that there's no requirement. I don't think that we have been filing, but I'm not too sure. So right, so by way of a note, I have said that these cases are excluded. There's still, I mean, there's still a compliance. You're complied with the section. If you're complied with the section, where's the question? We'll deal with that. Yeah. Sorry, come again. Can we show provision for expenses and no TDS done? So that is possible only in cases where payees are not identified. If the payee is identified and you have made a provision, then really speaking, it is not a provision, it's a liability, but it could still be provision if you are not able to ascertain the amount to the fullest extent, because that is the definition of provision in ICDS 10. A liability is a present obligation arising out of past event. And provision is where it is a present obligation, but the amount is not completely ascertained. So that is where you make a provision. If you know the party, and if you know the amount, sorry? If you have not received the bill from the party, but if there is an existing agreement, either oral or written, like say audit fees, you know that this is an audit, he is appointed as an auditor, his bill will come next year. But you are making a provision for audit fees, you will do a TDS on it. So it's like that. So I mean, if there is an agreement, if the person has rendered service, there is a certainty of that, then it is no longer a provision. Merely because an invoice is not received, it is still a liability, present obligation arising out of past year. Yeah. But then you can't take advantage of your own wrong. Apply for TAN immediately. So you apply immediately. He doesn't want to apply. So you report. So not applied for. He is not TAN number, so not applied. But you will have to say non-deduction. It will have to be a qualified 3CD, right? But it will have to be in your 34, or it will have to be here. They're not there, not applied. It should be according to me. You'll have to apply in 3CA. It will have to be a qualified 3CA. Yeah. Even if he does not have a TAN number, Nothing prevents him to apply for 10 number. So okay, so I think so long as you qualify your 3CA, your duty is over. All right. Then bonus or commission. So this is also a very old clause, and guidance note really helps you over here, because like issues have a reason. Issues can arise as to what happens if certain amounts of ex gratia or good work reward or whatever you may call different variable pay or whatever names you give, whether these amounts to bonus and commission covered under 36(1)(2) or not. So 36, so it is those 36(1)(2) cases which will fall under 43B, and they have to be paid before the due date of filing the return. If they are not paid, you have to report it. So questions arises as to what would qualify here and what would not qualify here. You have the exposure draft of the guidance note, there are 46.20, which says that emoluments in the nature of good work reward, incentives or ex gratia are not bonus or commission as contemplated under section 36(1)(2), but are deductible under 37 as held by the Delhi High Court in Ram Piston's case. So they've just relied on one particular decision and uh, given us some leeway as tax auditors that, okay, you rely on this decision, but if you rely on this decision, better write a note saying that I have not considered ex gratia, I have not considered good work reward, etc., or incentives I have not considered for the purpose of 36(1)(2). If you go deep into the subject, there are several decisions on this issue, right from 24 ITR, 47 ITR, 108 ITR, etc., etc. And the principles which actually emerge out of these decisions is principles are not very simple to implement all the times. One which is coming out clearly is that if bonus or commission forms part of the contract of employment and it is based on employee's performance, then it is salary. I decided to pay you if you do this good work, so variable pay. Forming part of the contract, based on your performance, I paid, it's not bonus. You may call it bonus, but it is still a salary outside the purview. That portion is very clear in the various decisions that we talk about. Now, if on the other hand, if it is based on, it is forming part of the contract, but based on employer's performance. So my turnover or my profit, the employer's turnover or profit or any other criteria, based on that, if that man is rewarded, then it is in the nature of bonus or commission. And if it is in the nature of bonus or commission, it will have to be reported if it is not paid before the due date. So these two principles are fine. So far as the third is, if something does not form part of the if it does not form part of the contract of employment, okay, I don't say, so therefore you call it ex gratia, you call it whatever name, then generally it is a bonus or commission. Delhi High Court in that Ram Pistons has taken a view that all these ex gratia, good work, etc., are not bonus or commission, need not be reported. There, the facts are not coming out very clearly as to whether it was forming part of the contract or it was not forming part of the contract. So, nonetheless, you have the guidance note to rely on in case in case of any doubtful areas. I think you can rely on that and go ahead. Profession tax of employees, whether needs to be disclosed. Now, it is a tax because tax duty cess or fees, clause A, what it says, and therefore it is a tax, no doubt. But it is not a deduction which is otherwise allowable to me as tax. And it is a deduction from employee's salary. And although it is deduction from employee's salary, employee's profession tax not paid, it is not covered under 224. 224(10) covers only cases of deduction for any funds. It does not cover profession tax paid. So it doesn't become my income. And it is otherwise not an allowable deduction. So 43B does not apply to. Although it is tax, it will not be covered by 43B because it is not my tax, it's the employee's tax. GST liability to be disclosed gross of ITC or net of ITC. So again, differing practices, different firms and different companies are following different practices. So do I disclose my GST liability on gross basis before ITC credit or after ITC credit? If I look at the language of the section, it says sum payable. What is the sum payable? According to me, sum payable is net after claiming a TDS liability. Sorry, ITC credit. Again, in accounts, what liability I would show is a net of ITC. Actual payment that I'll make in April, May will also be net of ITC. So in real life situation, if the actual payments are disclosed, are available and that would match with the amounts that you have reported, life becomes very easy. Okay, if you show the gross amount and then therefore you have to say payment so much, ITC credit so much and total so much, life becomes slightly difficult. So I would prefer that you go by the net theory and not the gross theory, but make a complete disclosure. How have you interpreted it? Because both effect is the same. If you show on gross basis, so say income, you will show 100 plus 18, 118 on gross basis, and income you will show 100 on net basis. Expense, say 50 plus 9 GST, 59 on gross basis and 50 on net basis. And if you're following gross basis, you'll make a provision of ₹9 in your accounts, and therefore there will be an expense. So ultimate net profit is the same. So effect will be the same. Under both the situation, 9 is amount which is payable. So here also, actually, the 9 is the amount which is sum payable. And 43B talks of any sum payable by of tax, duty, cess or fee, and sum payable is only 9, it is not 18. So I think the correct method is, according to me, it should be the net, but I see differing systems being followed by different firms and also by large corporates. There are different methods followed. Best thing is whatever you follow, please write a note. How much time do you have? 5-10 minutes. Okay. 43BF, leave encashment. So we have this decision of Supreme Court. We had Calcutta High Court earlier in Exide. Supreme Court confirmed that 43BF is constitutionally valid and therefore leave encashment will get covered under 43BF. So all those issues, constitutional validity issues settled. This is a development of last year. Now, is there any scope on leave encashment to still say that 43B does not apply? And the scope is like this, that 43BF says any sum payable by the SSC as an employer in lieu of leave. So when does it become sum payable? It becomes sum payable when an employee leaves. When you are making a provision based on actual valuation, it is not sum payable. It is an accrued liability based on actual valuation and a present obligation arising out of past events. Supreme Court in Rotork, etc. You apply that theory, Bharat Earth Movers and all, you apply that theory and we come to a conclusion that it is an allowable expense, an expense incurred, scientifically determined, and therefore allowable under 37. But it is not sum payable and therefore not covered under 43B. 43B itself has an explanation where they have said in respect of clause A, and clause A is tax, duty, cess or fee, whereas leave encashment comes under clause F. In the context of clause A, you have explanation to say any sum payable means a sum for which the SSE incurred liability in the previous year, even though such sum might not have been payable within that year under the relevant law. So it may not be payable, but so long as you have incurred a liability. So that explanation is only there for clause A. It is not there for clause F. So therefore, it is still open for one to argue that so far as leave encashment is concerned, it is not sum payable. It is a sum payable only in respect of those employees who have left. For those employees who have left during the year and have not paid leave encashment, it is a sum payable you must pay before the due date. But if you have not, if it's an omnibus provision based on an actual valuation of your leave encashment liability, then it is something which is still arguable that it's not covered by 43B and therefore you need not disclose it. There are various tribunal decisions. When I was preparing this last night, I couldn't get the decisions handy. There are various decisions on this issue. I think Grasim is one of them, Bombay Tribunal, and there are many other decisions on this. So you can probably rely on them and make a note of disclosure and still try and make a claim, but please make a note of disclosure. This is highly debatable. As the question as to the first question will arise that the Supreme Court decision, which has upheld 43BF, now concludes the issue. They've also considered Bharat Earth Movers and concluded the issue. So therefore, now this argument does not survive. Okay, that could be a possible counter from the department. And the answer to that is that Supreme Court was really concerned with the constitutional validity. It was not concerned with the interpretation of some payable, and therefore you cannot take the decision of Supreme Court beyond the question which was posed before them. Anyway, Senvet Credit 27A. You have an interesting clause here, which relieves many of us from our obligation of reporting anything over here, because there was a doubt as to whether GST etc. has to be reported here or not. Senvet was an old thing, but then guidance note para 47.9 says it is pertinent to note that since implementation of GST from 2017, central excise has been subsumed in GST and is leviable only on 6 products: petroleum, diesel, etc., etc. Hence, reporting under this clause is restricted for only those SSEs who deal in these products. 22-23 guidance note did not have this paragraph, and the information as regards GST credit is not to be supplied if the exposure draft gets finalized in this particular form. So this is some sort of a relief. Then comes the GAR issue, and once again over here guidance note comes to our help, that it says that GAR is a primary onus which is on the department. It says the provisions are complex, and it says that tax benefit arising not only to the SSE but all the parties who are concerned in the transaction have to see the tax benefit of all together. I don't have any access to the books of account or the records of those other parties and what tax benefits they have given. I don't know, and therefore I'm not in a position to comment on that. It also says that whether the main purpose is to claim tax benefit or not is the basis of GAR. Now that is a matter of opinion. How does my opinion bind the tax department? Because there's an entire procedure, entire penal procedure is prescribed over there, and therefore it's only a matter of opinion. And then therefore they have suggested a good draft, one which one can really adopt. It's more or less saying that I'm not going to report anything. This is it. In absence of the excess of the books of account and other records of various parties to arrangement and want of elaborate investigations beyond ordinary process of audit involved in determining whether the arrangement is an impermissible avoidance agreement, and in determining the tax benefit in the assessment year relevant to the previous under audit arising in aggregate to all the parties to the arrangement, you are unable to determine the view of the SSE regarding its or his entrance into the impermissible avoidance agreement as contemplated in the 96 review. So SSE is taking a view, you take a MR, and I don't have any wherewithal to examine that comments. This is what the guidance note has given to us, and I think 99% of us will follow this. What has the auditor to do? Auditor has to do here, of course, he has to make in his checklist that has any proceedings been initiated against you by the department? If there's a show cause, obviously you'll have to report. If there are any transactions in connection with those proceedings, you may have to report. Or if there is something which has already some action has already been taken and a transaction in relation to the same action, then you have to report. But these are rare cases. As of now, GAR has not been made not been so much implemented, and therefore by and large we will get away with that note at least for the next couple of years. 269 SSST T, I only wanted to bring out certain due diligence aspects from the audit point of view. These are all talking of deposits, cash deposits, etc. And practical difficulties are there, and every one of us right from day one have been writing proper, notes, the 3 CDs that I do not have the data, etc. But nonetheless, some sort of a due diligence checklist will have to be there, and we'll have to keep your records, working papers to show that I have exercised my mind and my boys have done this work. Now, what is that? Scrutiny of cash account and cash book, both receipts and payments. If you find something, then obviously you have to report. But if you don't find, forget. So cash book and cash account. Then on cash account, cash book scrutiny, there are suspicious entries like 19,900, entries of 19,000, multiple entries of 19,000, 18,000. Then this may give rise to some suspicion. Then of course you will have to document it, ask the queries and then 269 ST, one may have to do the sorting of the cash account or the cash book dump, which will be based on the name of the payer, because for aggregate from a person in a day. So you'll have to show something that, based on the name of the payer, you do some sort of a sorting and find out, all put together in a day what is happening. Because there may be multiple entries, you will never come to know. Then sorting based on invoice numbers or PO numbers, because from a single part, for a single party or for a single event, how do I identify? It's beyond my wherewithal to do that. But some due diligence exercise, you do that sorting of that ledger dump in your Excel sheet and find out based on invoice number or PO number or party's name or product description or something like that. You've done that work, you've done that exercise, you have found nothing, maybe on a test take basis, I think you are home. Again, a quick review of the bank statement, because bank statements would generally say either NEFT or clearing or UPI or something of that sort. And what are they saying about cash? Each bank will have its own way of doing it. A quick review of that to find out any entries where it indicates cash, and then have you asked questions on something which is beyond 20,000, keep it on record, because otherwise there is no way of finding out error check payments, etc. Take systems note, study internal audit report on the payment systems followed or cash withdrawals and deposit. Keep extracts of those internal audits in your working papers. From tax auditor's point of view, that would be very helpful. Review the transfer entries by way of JVs, and that should be a part of the procedure when your boys do your ledger scrutinies, that all the JVs, one will have to look at A account debit, B account credit. Is that otherwise then by account pay check, then there's a problem. So those JVs will have to be seen as part of your ledger scrutiny. And of course, all sorts of disclaimers and limitations that you put in 3CA, 3CD, you should put. GST, they have the guidance note essentially says head-wise, nature-wise details of expenditure not intended to be given. Only totality has to be given. You don't have to give various expenses. Non-cash items like depreciation, bad debts not to be reported. Transactions that tantamount to supply only has to be reported. So like employees, etc., not to be reported. Reconciliation with the revenue and capital expenditure, because GST will be there even in their P&L items, it will be there in the balance sheet items. So expenditure will have to be it will be both, because the clause 44 talks about expenditure, registered parties and non-registered parties. So reconciliation with the revenue and capital expenditure necessary reporting will be of items for which the invoices are received and recorded, because if mere provision are made without receipt of invoice, then that GST reporting will be impossible. So therefore, for this particular clause, you may have to only take up items for which invoices are received. And once again, this will not tally with your P&L, and therefore a reconciliation, wo dono ke beech mein there is a provision which is made. So again, a reconciliation will be really, really important. So an ongoing exercise of GST reconciliation, keeping in mind clause 44 will be very important. Disclosure by the auditor. So whatever interpretation you are taking, what do you mean by expenditure? How have you gone? You've gone invoice wise, you've got payment wise, or fact that you've excluded the provisions, or whatever other interpretation issues are there, better write by way of a note. Many large clients unable to furnish, just say unable to furnish. If they're giving you reasons why they are unable to furnish because of volume, etc., say that, and then you're out. So this is what the disclosure is all about. Anyway, friends, I think I tried to cover all issues that come up in the current year. I'm not going into the whole thing as a whole. It was a nice interactive session. Thank you very much for the patient hearing.
the next 5 minutes, please.
Thank you, Yogesh, for this very wonderful session. I think the sheer attendance can show how nice and wonderful this is. Uh, Before we propose the vote of thanks to our speaker today, I would just like to make a note here. I would request all of you to please come a little early on time because it gets a little messy to get the chairs in between and also to intimate the hotel staff to increase the breakfast count. It gets a little uncomfortable. And I would also request you all to please be little cooperative while taking breakfast because we've already increased the count, but still it might be a little delay in refilling. So please cooperate with us today. And also we have a small lucky draw for everybody who's present here. This is a part of the 25th year celebration that we are doing this year. So after the vote of thanks, we will declare the lucky draw winners. To propose the vote of thanks, I would like to invite C.A. Jai Shaji, who is a past convener, and vote with him.
Thank you, convener, for giving me this opportunity. Friends, all of you will agree that even after 30th year of 44 EB on statute, we have a lot of things to learn and we cannot have a better speaker than Yogesh Bhai, who can make us understand intricacies of various issues. He has selected 12 closes out of 44 and given his experience of last 40 years in 1.5 hour, and we are all thankful for that. I, on behalf of all of us sitting here, propose a very hearty vote of thanks to Yogesh Bhai. Thank you very much. I request all of you to give a standing ovation for his excellent work. Thank you very much.
Sir, I would request you to take out the.
एंड करायचं